Hi. Today in Chapter 3, Measuring Business Income, we're going to focus on Objective 5, Allocating Recorded Costs Between Two or More Accounting Periods. In Objective 5, we're going to focus on how to go about allocating recorded costs between two or more accounting periods by preparing typical types of adjusting entries. During Objectives 3 and 4 of this chapter, we learned about accrual accounting and how we apply the concepts of accrual accounting through the matching rule and adjusting entries. In Objective 5, we're going to learn about the 4 different categories of adjusting entries, accruals, and deferrals of revenues and expenses. Let's look first at the first type of adjusting entry called allocating a deferred expense. Common examples of a deferred expense are prepaid insurance and converting it to an insurance expense, and supplies, the asset supplies, and converting it to supplies expense. The key here is that we're going to be crediting an asset account and debiting the expense account. We're going to adjust these amounts or these accounts in equal amounts depending upon the cost of the good or service that is being used up or expired during that accounting period. The idea here is that we're going to allocate a portion of an asset that we've used up in the current period to show how that asset is being used in the business and expensing it to help generate revenues for that business during that accounting period. We do this through the adjustment whereby we credit the asset to show the reduction of the asset, and we debit the expense to reflect the portion of that cost of that asset that we just used during that accounting period. Now, once it's expensed, we show or we help to match revenues with expenses, reflecting the appropriate level of net income for that accounting period. Another kind of Type 1 adjusting entry allocating deferred expenses is the adjustment for depreciation of property, plant, and equipment. It is a very common type of adjustment, but just a little bit more complicated. You will notice here that in this adjustment, which is slightly different than the adjustment we just learned about, we're going to debit, in this situation, a depreciation expense account, and in this category, we're going to credit, instead of the asset, we're going to credit what we call a contra asset account. Again, the debit and the credit will be for the equal amounts, and the idea would be to show how that asset is being used up during that accounting period and applying the matching rule. Let's look at this depreciation in a little bit more detail. So, when a company buys a long-term asset, a building such as trucks or computers or store fixtures or furniture, it is in effect prepaying for the usefulness of that asset for as long as the asset benefits the company. The long-term asset is considered a deferred expense, meaning the company has acquired it, but it hasn't used it all up yet, and therefore it is not expensed yet. But as it uses it up, we must allocate a portion of its usefulness in each accounting period to show that it is being used up. Because long-term assets are deferred expenses, the accountant must allocate the cost of the asset over the estimated useful life of that asset. The amount allocated to any one accounting period is called depreciation or depreciation expense. Depreciation, like other expenses, are incurred in each accounting period to help generate revenues for that business. Let's look at a few definitions to help us understand this depreciation concept a little bit more. Depreciation expense, like other expenses, is incurred in each accounting period to help show how a long-term asset was used up during that accounting period in which it helped to generate revenues for that business. It is often impossible to determine exactly how long an asset will actually last or how much is used up in one accounting period. Therefore, businesses use depreciation as an estimate, and the accountants make assumptions that are applied consistently to determine the amounts of depreciation to allocate during each accounting period. Using these assumptions, they calculate the amount of the depreciation and debit that depreciation expense of that asset. They then credit the accumulated depreciation associated with that long-term asset. The accumulated depreciation is a contra account, and it is used to reflect the total past depreciation of a specific long-term asset. Each long-term asset maintains its own accumulated depreciation accounts. On the books of the business, the accountants do not show the value of the long-term asset decreasing. Instead, they show the asset at its cost, and they create this accumulated depreciation account and match it with that long-term asset. This account is used to show the total accumulated depreciation associated with that long-term asset account while still maintaining the asset at cost on our balance sheet and applying the cost principle. The contra account is shown as a separate account, and it reflects the balance and shown as a deduction from the related account to ultimately determine a net value for that particular asset. The net value is reflected as what we call the book value or carrying value. And simply stated, the equation for the book value is the cost of the original asset minus the accumulated depreciation. Assets are reported on the balance sheet at their net book value, and then accountants reflect the cost and the accumulated depreciation in a footnote in the financial statements. Let's move on and look at a Type 2 adjustment for accrued expenses. Common examples are accrued wages, estimated income taxes, interest expense, and utilities expense. At the end of an accounting period, there are usually expenses that have been incurred but not yet recorded. No cash has changed hands. These expenses require an adjusting entry to ensure they are accounted for in the period in which they were incurred. For instance, interest on borrowed money on a loan. Each day, interest on the outstanding loan is accumulated. At the end of the accounting period, an adjusting entry is made to record the accumulation of that interest as an expense of the business for that period, and a liability associated with the expense is recorded to reflect that the business owes the interest payments to the other party that the loan was taken from. The interest or cash payment itself may not occur until a later date, but the business must show that the interest is owed during that accounting period as the interest accumulates, and it must expense that amount to reflect or apply the matching rule. It does so by debiting interest expense and crediting an accrued interest payable. Another example is accrued wages. Let's say, for instance, a company normally pays its employees on Friday, but the end of the month occurs on Wednesday. At the end of the month, which is an accounting period, at the end of that month, the company owes wages to its employees for 3 days, Monday, Tuesday, and Wednesday. However, it won't pay them until Friday. There has been no change of cash. The cash change of hands won't take place until Friday. But the company must still report the expense for those 3 days and accrue the wages on its balance sheet as wages payable and on the income statement as wages expense. So they would debit the wages expense and credit the liability, wages payable. Accrued expenses as a definition. Accrued expenses and a corresponding liability that accumulate with them or accrue over time. Let's shift gears and look at a Type 3 adjustment for unearned or deferred revenues. As we've learned in the past, unearned revenues are a liability. Unearned revenues, from a definition standpoint, occur when cash for revenues is received in advance of that revenue being earned. A company has an obligation then, after they receive that cash, to either deliver the goods or perform the service. Just as expenses can be paid before they are used, cash can be received for revenues before it is earned. When revenues are received in advance of them being earned, the company must record that obligation as a liability, because the company must, at some point in the future, perform the service or provide the goods. Once the service has been performed or the goods have been delivered, the company must record or recognize the earnings of the revenue by completing an adjusting entry to recognize that portion of the unearned revenue that has been earned, and therefore then the reduction in the outstanding liability, as the company really no longer owes that portion of the good or service to the other party. So in this case, the adjustment or the adjusting entry is to debit the unearned liability to decrease its outstanding balance and to credit the revenue associated or reflecting the earning of the revenue and increasing our sales. Let's look at the fourth type of adjustment. This is an adjustment for unrecorded or accrued revenues. These would include such things as accrued fees or interest on a note receivable. Accrued revenues are revenues for which a service has been performed or goods delivered, but for which no entry of cash has yet been recorded. Accrued revenues are any revenues that have been earned but not yet recorded during the accounting period, and therefore they require an adjusting entry that debits the asset account and credits the revenue account. Let's look at an example. Let's say we have a note receivable. Every day, interest on that note receivable is being earned, but it might not yet be recorded, or might not yet be received until after the end of the accounting period. The interest receivable must be recorded as an asset, and the interest income associated with it must be recorded as a revenue earned during that period. We may indeed receive the cash at a later date and time, but we still must record the fact that the earnings took place and that an amount of money is owed to us. So we would debit interest receivable and credit interest income for equal amounts. So let's ask ourselves the question: why do businesses perform adjusting entries?